politics, policy, and economics, both globally and domestically, have an impact on real estate prices? Yes, give me an example.
Interest rates.
So Larry's favorite game. Tell me about interest rates.
Like if no one can
Give me the
borrow.
10-year treasury yield. Where is it today? Where was it the day after Brexit? And how many basis points did it go up or down? You can look it up. You have phones, you have tablets, you have a computer.
2.38.
What?
2.38.
2.38. Okay. And is that up or down compared to a year ago?
The same.
A year ago. Is it up or down?
Yeah.
I don't think so. You gotta look it up. You gotta get on your phone and look it up. Okay? And start looking up the 10-year treasury. Does the 10-year treasury have an impact on commercial real estate prices? Yes or no? You wanna probably turn this on. Does the 10-year treasury fluctuations, is it on?
Yeah, it's on.
Have an impact on real estate prices? Yes or no?
Yes.
Yes. Does the fluctuations in the 10-year treasury yield have an impact on the cost of capital?
Yes.
Does the fluctuations in the 10-year treasury have an impact on bonds and stocks? Yes. Okay. So if the 10-year treasury yield is up 100 basis points since Brexit, where have mortgage interest rates, both commercial and residential, gone? Up or down? Up. And if interest rates have gone up, is the cost of mortgage finance gone up or down? Up. And if the cost of mortgage finance goes up, do the values of real estate go up or down? Down. Holding everything else constant. So interest rates and the cost of mortgage finance, since real estate is highly leveraged, has a major impact on real estate values. So you have to look at the 10-year treasury because commercial mortgage interest rates along with residential mortgage interest rates are benchmarked off the 10-year treasury. Okay? All right? What did the stock market do? Here you go. You get a magazine. And I'll throw in a paper because I sent you one.
Is it signed?
I will. What's the stock market doing?
You mean right now or afterwards?
No, right now, where is the S&P 500 or the Dow? Let's use the Dow. Where's the Dow Jones Industrial Average as of today? What did it close at? Does it matter where the stock market is? Does it have an impact on real estate prices? Will the stock market have an impact on real estate prices?
Yes.
Yeah. Okay, so where is the Dow Jones today? What did it trade at? Where did it settle?
19,971.
Okay, well, did it ever breach the 20,000? Yeah. Okay. So it didn't break through. It broke through, but it didn't continue going on, so it wasn't a breakout to the upside. But it looks like there's definitely a resistance at around 20,000. Now, if the stock market goes up significantly over a period of time, and I can get a higher risk-adjusted rate of return in equities than I can in real estate, what am I going to do? If I can get a higher risk-adjusted rate of return or even a higher rate of return for some investors in the stock market over real estate, what am I going to do? I'm going to invest in the stock market and I'm going to do what with real estate? I'm going to probably sell. So is there asset class rotation? Do people move in and out of different asset classes? You know, from stocks into bonds, from bonds into gold, from stocks and bonds into real estate, out of real estate into stocks and bonds, and maybe gold. Do people trade amongst the 5 major asset classes? Yeah. So if the stock market is at an all-time high, then what is the cost of equity for most publicly traded companies? Is it high or low? If the stock market is at an all-time high, what is the cost of equity for publicly traded firms? High or low? It's going to be what? It's going to be high, right? High, high, right? High? No, no. You got totally set up. No, you're wrong. People will set you up and give you the wrong answer and get you to say yes when you're wrong. When the stock market is at an all-time high, the cost of equity is low. I know you did, but nobody said anything. And a lot of people said, no, you're right, Professor. So when the stock market is high, you know, the cost of capital is low, which is right. Why is that the case? Because if you look at the dividend discount model, right, this is your dividend, or your cash flow, or your earnings per share, or whatever it is, and this is the price. This is your proxy cost of equity. So if the price is high, your cost of equity is low. So if I'm a publicly traded real estate investment trust, a REIT, and my stock prices are at an all-time high, what's the cost of my equity?
All-time
It's at an
low.
all-time high. Am I gonna issue more equity?
Yes.
Yes, I'm gonna issue more equity. Right? And if bond prices are at an all-time high, what's the cost of my debt? If my bond prices are at an all-time high, what's the cost of my debt? It's gonna be, bond prices are high, that means my cost of debt is gonna be low, right? Because I could basically just take this and change it to a coupon, couldn't I? For the bonds. So if my bond prices are high, my cost of debt is gonna be low. Is there an inverse relationship between interest rates and bond prices? Yes. Is there an inverse relationship between interest rates and stock prices? If interest rates are high, do stock prices go down? If interest rates go up significantly, do stock prices go down? If interest rates go up, do bond prices go down? Yes. If interest rates move up rapidly, do real estate prices fall? Yes. So you have to burn into your brain that there's an inverse relationship between the cost of capital and interest rates and asset prices. You need to burn it into your brain, okay? Because if you're in the elevator with Charles Schwab, and he's going, can you believe what the 10-year Treasury yield did today? I can't believe it went up that high. And you're going, yeah, I can't believe it. I mean, bond prices are at their all-time high. You're fired, right? Because everybody knows that when interest rates go up, bond prices go down. When interest rates go down, bond prices go up. Okay? You gotta burn that into your brain and write that equation in, because you're a senior in finance in this program getting ready to leave, and you don't know the relationship between interest rates and bond prices. That's a problem. Okay? Anything else? Anything else that's happening right now that you think could have an impact on commercial real estate? What? What? Yeah, start giving me the list. The policies that could impact real estate.
Banning
What?
certain groups,
No, give me some examples.
banning Muslims, which have worsened trade ties with other
Okay,
countries.
so we ban Muslims coming in. Do Muslims usually bring in their wealth with them,
Yeah.
along with
They have to
family?
buy their way.
And what do they usually do when they move here?
Start businesses.
They usually start businesses and they buy real estate. Is that gonna have an impact? Maybe, maybe not. It could have an impact. So immigration policy could have an impact on aggregate demand for housing and commercial real estate in investment counties. What else?
Well, that's what I was gonna say, that, you know, a lot of the tech companies are saying that.
Okay, if the tech companies can't get foreign immigrants from India and China to become engineers over here, which are highly paid, could it have an impact on the value of high-end real estate here in San Francisco and Silicon Valley?
Yeah.
If they were deported, if they're deported, if all of a sudden all that money and all that human capital now has to leave, is that gonna have an impact? What are they gonna do when they leave? Are they gonna keep the home here, or are they gonna sell it? They're gonna sell it. Okay, which could have an impact. What else? What other policies?
If you tax companies that outsource and make them build in the US.
Okay, so he's gonna tax companies that outsource their manufacturing and import it back into the United States. So if the imports, let's say those imports are taxed at 45%, what's that gonna do to the price of those goods? Gonna go up. What does that do to inflation? Goes up. What does that do to inflation expectations? What happens to interest rates? Goes up. And if interest rates go up, what could happen to stocks, bonds, and real estate? Go down. Here's the game. Get it? This is the game. Larry's favorite game. let's go through it and we figure out what the impact is gonna be on prices. If I think that prices are gonna go down for real estate, can I hedge it? Can I hedge?
Yeah.
How do I do it?
Sell it now.
Okay, that's not
Or
hedging,
it takes.
just liquidating, that's an exit strategy. Can I hedge real estate prices?
Would you buy against things that are negatively correlated with real estate?
You could play that game, but I've never been able to get anybody to do it. So if I had a index, maybe the Case-Shiller index, a Moody's index, an RCA index, a CoStar index, a Standard & Poor's Commercial Real Estate Index, and I think we're at the peak in 2017, what's the probability that the market is gonna go higher or the market's gonna go lower? We're already at an all-time high. What's the probability? What probability is higher? That it's gonna continue to go up significantly or could potentially go down? Could potentially go down. Can I hedge my real estate portfolio, the value of my real estate portfolio, if I think the market's gonna go down in the next 2 years? Can I? No. There is no accepted index. And if there was an accepted index, whose prices or returns were highly correlated to my portfolio, could I write forward contracts? If I think that the market's gonna go down, and there's an index, and there's derivative contracts available, could I write a forward contract to hedge off the downside risk in my portfolio? Yes. So I can write forward. What else could I do?
Futures.
I could write futures. What else? You equity people, and you bond people are spoiled. Us real estate people are screwed. We're totally subjected to the market. We do not have derivative contracts to hedge off our portfolio risk. What else can we do? Yep. So can I write calls on futures? Can I buy puts on futures? Can I do that? Could I write calls on REIT ETFs? Can I write calls on the ETFs? The REIT shares? Can I write calls on them? If I think the markets are gonna go down?
Yeah.
Yep. Can I buy puts?
But it's probably
Can I buy puts on the REIT ETFs? And hedge it off? Can I? Yes? No? Yes or no?
on our entities.
Yeah, the REIT ETFs.
Yeah.
Yep. Can I write calls on major REIT stocks? Can I write calls on major REIT stocks?
Yeah.
Yes. Can I buy puts on major REIT stocks? Yeah. Can I hedge? Can I hedge off the portfolio if I think the markets are gonna go down?
If it's public.
Can't do that, can't do that, can't do that, can't do that. I can probably do this, I can do this, I can do this, and I can do this. If I think that interest rates are gonna go up, I could probably use swap contracts, or I could use interest rate futures and forward contracts. I can use derivatives to hedge off the risk in my real estate portfolio, either by publicly traded bonds or stocks, maybe the real estate, and if I have a large portfolio of REIT shares, publicly traded companies, real estate companies, I could probably hedge off the portfolio too. But I can't hedge off the direct real estate because there's no real tradable indexes with derivatives on it. You've taken institutions, you've taken investments, you've taken the corporate finance, you've studied the derivative applications, you can't do it in direct real estate. There's no indexes and there's no derivatives. Okay? So I will ask you later about the game, and then I'm gonna ask you about the trades. How would you hedge it off? What would be your strategy if you had a view like this? Okay? We talked a little bit about any questions on this, because that's gonna flow right into the memos, right? Because if you read the memos, you know that you're gonna have to make a forecast of the prices for those property sectors based on 3 economic factors. And you're gonna have to make the derivative trades, assuming we have an index, knowing we have ETFs, and knowing that we have shares. So I'm assuming that we have indexes for office, industrial, retail, apartments, and hotels, where we could do the forwards and the futures, you know, the options on the futures contracts. Because I want you to learn how to do the derivative trades. Okay. This is really tough because we have basically $20 trillion worth of direct real estate here in the United States that's totally naked. There's no hedge. There's no derivatives. There's no index. So you own all this billions of dollars worth of real estate and you can't hedge it like the fixed income and the stock guys can do.
So what'd you do?
Well, I tried to build the index and develop the markets. We went into the recession in 08, 09, and they fired all of us. And Wall Street, we found out, did not have the balance sheets capable of generating and building a capital market in real estate. And it will probably never happen again. Maybe 2025 through 30, or 35 through 40, that's 10, 20 years out. That's a long time. The markets have changed. So you may want to do that. I'll support you, I'll help you if you want to build these indexes, but it's really hard to find somebody who's gonna, we can build the indexes, but we don't have the balance sheets. We don't have Wall Street anymore that has balance sheets to be able to build these markets. You've got to have balance sheets. Okay, let's do any other questions on those?
Well, you have right calls on REITs, I think twice, is that?
Right calls on REITs, and then buy puts on REITs. Buy puts on REIT exchange traded funds, and right calls on REIT exchange traded funds.
Okay,
So you can do it on the REIT exchange traded funds, and you can do it on the individual REIT shares. Okay?
Futures are hypothetical.
These are hypothetical. Because these are long contracts, they're over the counter, they're custom. I mean, there might be some institutional investors that are out there that have, $83 billion, in real estate, and they think the market's gonna go down. They gotta go find an index, and then they have to have somebody write the contract and give them the money. So they gotta go to Wall Street and say, hey, we'll use this index, we wanna go short, you guys are gonna write the, we're gonna write the contract and you're gonna buy it from us and give us the money.
So not. in
There's no
this-
market,
Yeah, not in this reality.
not in this reality. Exactly. But it was really close in 2005, 6, 7, 2005, 6, and 7. There was a window. And it didn't work.
So
Okay.
that includes mortgage-backed securities.
Yeah, we'll go through it all. On the real estate agent license, go up to the Bureau of Real Estate, click on agency, go to Dwayne Belmer. Get the courses, get the test prep, and get your license. Okay? Do it as quickly as possible. Once you get it, you're in. If you don't have it, you're out, right? Can you sell real estate in the state of California without a license?
No,
When you go for a job as an asset manager, or portfolio manager, or property manager, or property, coordinator, or an assistant property manager, do they want to see that you have your agency license?
Yes.
Yes.
Not necessarily.
They do.
Not if you're with the property manager.
But what if you get fired?
That's another story, but when you go to the companies, it's under their umbrella.
I know, but if you have it, what are they gonna say?
They're gonna say no.
Right, and if you don't have it? What if you don't have it and they value it?
Well, then you get it.
That's right, and then what if you have it and they don't value it?
So I don't know.
But what if you get laid off and you decide you wanna go into investment sales? Is it good to have your agency license?
Oh, it's always good.
Always good to have, okay? Somebody who has experience. And then you're gonna join the National Association of Realtors, which is the largest lobbying organization in the country, with over 2 million agents. California Association of Realtors is one of the most powerful organizations from a state level lobbying organization, and the San Francisco Association of Realtors is one of the more powerful local organizations. You belong to all three of these when you join the local board, so you get your license, you join the board, you're in. You're in. Okay, let's do the memo review. So the memos, you have 5 of them that you have to do. Office, industrial, retail, apartments, and hotels. Okay. Did anybody not get a copy of a memo template? Okay, I got one. Will you do me a favor, will you go hand out these? Just one for each.
Are these on item?
No, that's the introduction to real estate.
Wait a minute.
No,
There's a lot of hands. I like to read.
that's okay, just give one to each. Just one. Now, these are technical memos. She's gonna hand them out. These are technical business quality memos, okay? They're in a very specific format, okay? Some students replicate these things to the T, which is great, okay, because I'm looking for a specific format. Did you get it all out?
You
No,
only
one
did
each.
3.
No, one each, not one package each,
Oh,
one each. Not all 5, you just gave away the whole thing. Just one each, thank you. So you have 5 property sectors that you're gonna do, and you're gonna forecast the property sectors, not San Francisco, but you're gonna do it on a national basis. You can talk about San Francisco, but you're gonna do it on a national basis. And that's why I ran through the regression, because basically what you're doing is in your brain, you're building a forecast model to forecast price. Okay? So you're gonna forecast the price trajectory. You're gonna have to tell me where you think the price of office buildings are gonna go over the next 6 to 9 months. Okay? You're gonna tell me what direction they're gonna go. Now, test question. Do you think there is a correlation between occupancy, rents, and prices with employment? Yes or no?
Yes.
That's right. Employment is the #1 factor that drives demand for commercial and residential real estate. So you need to talk about employment. Now, office demand. Where does office demand come from? Total employment or office using employment?
office using it.
Office using employment. Give me some categories of office using employment. What?
Medical?
Medical office. We're not talking about medical office. Who occupies office buildings? What industries? Tech,
Financial,
financial services, excellent.
accounting,
Accounting, legal, exactly. So you can look, you can either go to the EDD at the state level, you can go to the Bureau of Labor Statistics, federal level, and you can I look up 1-digit SIC code or NICS code and look up financial services? Can I look up the employment just for the financial services sector? Business services? Yep. Those are the 2 sectors that are gonna be generating the majority of demand for office. What about supply? Will supply have an impact on occupancy rates rental rates, and prices.
Yes.
Yep. So if there's an oversupply and all of a sudden there's 8 million square feet or 16 million square feet of new office gets delivered in San Francisco over the next 2 years, is that gonna have a positive or negative impact on the rents? It's gonna have a negative impact. And what about the prices? They're probably gonna go down. Because as new product comes online, don't you think the landlords are gonna give incentives to try to draw tenants in from other buildings and lower the effective rents through concessions such as free rent? Yep. The supply should be another one of your factors. Either there's not enough supply or there's too much supply that's gonna have an impact on the price. What about industrial? What type of employment's gonna impact industrial? Manufacturing,
On warehouse.
warehouse distribution, what?
Refineries.
Less so. Refineries are a special purpose, special use type of real estate. It's not the bulk of the real estate. If you look at all the inventory, or the base of these buildings, it's a stock of inventory. If you look at the bulk of the buildings, it's gonna be office buildings, smaller garden, suburban office, central business district office, warehousing distribution facilities, 24-foot clear, 32-foot clear in markets such as LA, the South Bay, around the port of Oakland, in Oakland, around the port of Seattle, in Portland, and north of the airport in Dallas, and other areas across the United States. These are just big boxes. Does supply have a negative impact on net absorption, occupancy rates, rents, and prices?
Yes.
Yes. Yes. Net absorption, occupancy rates, you wanna write these down. These are all terms. Net absorption, occupancy rates, rental rates, and prices. They're all related to each other. Industrial, manufacturing, warehousing, distribution, ports, airports, trucking terminals, large areas where they have a lot of warehousing distribution facilities. What about retail? What would drive net absorption, rents, net absorption, occupancies, rents, and prices in retail? Employment. Okay, would it be specific employment or just total employment? Probably total employment. Right, because it's not, retail is not specific to different segments of the economy, it's basically overall health of the employment market. Give me some other factors that would drive absorption, demand, occupancy rates, rental rates, and prices up for retail. What else would drive retail sales? What? Let's be specific. Let's use economic variables. Tourism, definitely in San Francisco. Do you think Union Square is impacted positively by an influx of tourism? Yeah, so if you're in that submarket and you're building the forecast model, you're probably going to look at tourism, the number of tourists coming through the airport. Right? Give me some other factors. Yeah, if you have good transportation systems to be able to get to the mall and from the mall, BART, Muni, Uber, Lyft, taxis to get to shopping, is that gonna have an impact on the demand for that space? If it's easy to get to the shopping? Yes. What other, give me one
cost of
more.
money,
What?
willing to spend, the cost of money.
Okay, so consumer spending?
Yes.
No, not necessarily. Give me another definition of,
Monetary policy.
what do you
how
need
expensive
to have
it is.
consumer spending? You need to have jobs. If you have a job, what do you have? You get money, which is also called income, disposable income. Income per capita, wages and salary income, household income, per capita income. What about population? Would growing population have an impact on retail sales? Yep. What about household formations? Household formations. If households are being formed in the area at a rapid rate, is that gonna have an impact?
Yes.
Absolutely. Okay, absolutely. So these are all factors that will drive, if you're building your model to try to forecast the prices. Retail, you're gonna build a demand model, and you're probably gonna have households and household formations and income growth. And if you're trying to do figure out the prices at a very local level, you're gonna put in the transportation. You're gonna put in, micro factors, okay? What about apartments? What drives the demand for apartments? That would cause net absorption, rents, occupancy, rents and prices to go up. Transportation, definitely, if you own an apartment building, basically on top of the Pleasant Hill BART station, do you think that would have an effect on the rents and the value? Absolutely, absolutely. What else would drive demand for apartments?
Job
What?
retention.
Supply constraints will definitely have effect, and we'll get into that a little later.
Job retention.
Jobs definitely are the number one factor driving demand for apartments. Okay, what other factors?
And when you cannot get the loan for real estate, people go for them.
Okay, if you can't afford to buy a house, what do you do? Rent. Is that gonna drive demand? Yes. Who rents?
Newlyweds.
Who rents? People who can't afford a home, but who else rents apartments? Give me the age cohorts.
Younger.
Give me the age cohorts.
18 and 30.
What?
18 and 30.
Were you living in an apartment when you were 18? That's awesome. That's awesome. I didn't even get out of my house until I was 29.
20 to 35.
Huh?
20, like 25 to 35, 40.
Yeah.
Older
Yeah.
people?
It's like 25 to 35 is the prime renter cohort, but in a lot of markets, because of unaffordability, it's really 25 to 45. Okay. So if I'm gonna measure demand for apartments, would I have a population cohort? Would I have the population between the ages of 25 and 35 or 25 and 45 in my model? Yeah, would I have a job variable in there?
Absolutely.
Yeah. What about housing affordability?
No, you have
When
to.
affordability is really low, is it gonna have an impact on demand for apartments?
Absolutely.
Yeah. What about income?
Yes.
Yeah, income's gonna have an impact too. And if your market has a lot of high-end apartments in it, and you have high income, and people don't wanna buy a house, they're gonna live in the high-end apartments. Okay, any other factors on the apartment side? What about supply? What about supply? If new supply is coming on the market, will it have an impact on rents and values? Yeah, absolutely. I think right now, San Francisco's delivered like, maybe 4,000 to 6,000 high-end apartment units in the core for the first time in history. There's another 20,000 on the block coming. Maybe not all 20,000 will happen. But what happens when, later in the cycle, 2018, 19, or 20, when all those units start to come online and you go into a recession,
Oversupply.
what's gonna happen to occupancy rates?
A lot
down.
of vacancy.
Gonna go down. What's gonna happen to rents?
Go
Gonna go
down.
down. What's gonna happen to prices?
Down.
Okay.
What are they doing with that high-end apartment complexes?
Lawsuits,
That's it? Are
There's
they
a lot
tearing
of
They're
it
suing.
options
down?
right now.
hotels. If I was going to build a model to forecast room rates, or revenue per room, RevPAR, occupancy rates, overnight stay rates, hotel rates, what would be my variables in the model?
Tourism.
Tourism,
Transportation.
definitely.
Transportation.
Yeah, business,
Travel.
Travel.
business travel, exactly. What else?
Transportation.
Transportation next to the hotels is definitely important. Airports, definitely, if you're next to an airport.
International policies.
What?
International policies like immigration.
Yeah, if you have, tourism, what's gonna drive tourists to the United States in 2 destinations. Currency, right? So if the US dollar appreciates against foreign currency, are you gonna have more or less demand for hotels? If the US appreciates, less. If the dollar depreciates against foreign currency, are you gonna have higher or lower demand for hotels?
Higher.
Okay, all right. So that's kind of what I'm looking at for the, for the memos. We'll go over a little bit more, but, you know, look at these, replicate, then replicate, okay? Get them as close to this format as you can, and then I will read these with you, we'll go over them together, and I'll help clean them up. But think about the 3 factors that are gonna drive pricing. Put the data in the bullets to basically reinforce your forecast, and then put in either rental rates or occupancy rates or, you know, the technical factors so that I can see that you've done the research, you have the data, you've done the analysis that basically supports your factors, that supports your forecast, that basically ties into the trades. Okay. I had one of my students, he had an interview over in Walnut Creek. I knew the company and I knew the principal that was in the company. And he said, what should I do before I go in the interview? I said, bring one of your memos with you. I said, which one? I said, the one we went over together like 17 times. He brought the bond memo in, and when he was interviewing with the guy that he was talking to, he pulled out the memo to show him some of the work that he had done. He gave him the memo, and it was the bond memo. The guy who used to be a fixed income bond portfolio manager and trader, he's now on the mortgage side. He said, how did you know that I used to be in the bond side of the business? Bam, you got the job, because he totally connected with him. Okay, so let's go through how we do it on time. Okay, so I'm probably gonna go quick and then I'm gonna go back, okay? So introduction to commercial real estate, you gotta print out that memo that I sent you and read it, okay? And I would memorize it actually, to read it. It's a really good memo. It's basically, you know, the course in real estate practice and principles rolled up into a primer, okay? And it's got everything in it, okay? And it's really important. There are different types of investment strategies. You have acquisitions and you have development. You have 2 types of people. You have investors that just want what are called stabilized core assets. I want Class A apartment buildings. We want to buy Class A apartment buildings. Class A, B, C, D. Class A, Central Business District, mid-rise, high-rise, built after 1980. The best product. All of the product that you've seen, the office stuff, it's been built between 1st and 2nd on Mission Street. Go down there. Most of the inventory is brand new. It's been built within the last 10 years. Super new, all the cutting edge glass, all, you know, the state-of-the-art concrete, steel, HVACs, heating, ventilations, air conditioning, state-of-the-art product. Totally efficient, totally sustainable, with the highest, what are called LEED, which is sustainability ratings given to the buildings. It's by location, by quality, and the quality of the tenants that occupy the buildings are the best, and they get the highest rate. Okay? So there are pension funds and large investment funds that don't want to do a lot with their buildings. They want to hire an asset management company to manage it on their behalf. They want stable real estate that's going to kick off cash flow with maybe some appreciation, and they're going to hold the asset for 10, 20, or 30 years or forever, because they need those cash flows to fund their pensions or their other liabilities. So that's stabilized core real estate. So that could be one fund style, one portfolio style. The other is value add. I'm going to go in, down on Mission Street, between First and Second, and I'm gonna buy a building, it's about 100,000 square feet, that was built in 1950 or 1960, and I'm gonna gut it, okay? And I'm gonna redo the exterior, I'm gonna replace all the windows, all the HVAC systems in it, I'm gonna gut the lobby, I'm gonna fix up the lobby, and I'm gonna market the building and bring it from a C building to a B building. We're gonna be able to jump classes through a value add process where we're gonna invest a lot of money in it and we're gonna totally reposition the building. Okay? So that's value add. Opportunistic, there's a building built in 1940. It's got some physical characteristics and features that we want to retain, but what we're actually going to do is we are going to completely redo the building. Okay? So it's opportunistic. We're not just going to go in and remodel it, we're probably going to rehab it or redevelop it. So we're going to put a lot of money in it. We're going to take advantage of its location and maybe its physical, historical characteristics, and we're going to reposition the building. But it's going to be a lot more risky, and we're going to put a lot more capital into it. And we might even actually have to fix some stuff. Maybe reinforce the steel, or maybe redo some of the siding, or maybe we can add on, keep the facade and build a high-rise in the middle of the Greek facade that was originally there in the maybe 1920s. So this would be an opportunistic play. So that's really acquisitions right there. And different companies have different strategies in what they do. I can't sell an opportunistic deal to a portfolio manager or investor group that wants stabilized assets. So the market's segmented. Okay. On the development side, I can go in and remodel the apartment building. Put some landscaping in, maybe fix up the lobby a little bit, and every time a unit turns, I'm gonna go in and I'm gonna put in new cabinets, new countertops, toilets, rip out the carpet, paint it, maybe put in simulated wood, flooring, and I'm gonna remodel it and try to get higher rent that way. Or maybe add a little bit more, maybe put in a clubhouse, a pool or something, and maybe it needs some structural, maybe it needs reinforcement, steel reinforcement because it's an earthquake location and the building sits on mud that is susceptible to liquefaction during an earthquake. So I gotta go in and I gotta put in bracing, the new steel, the cross beams and the foundation, and maybe even sink some pilings to basically stabilize the soil to mitigate the impact of an earthquake. So that would be rehab.
What difference is that between that and opportunistic?
This is an existing property, okay? When you do the rehab, you're actually doing construction. So opportunistic could have some remodel, rehab, but this, the approach is development. So it could look like that. It could look like that. But depending on the degree, at some point in here, you're really a developer. Construction guys are doing this stuff, right? Doing this, there might be some development there, but the development and redevelopment could be opportunistic, but there's an existing building here. Redevelopment is you're basically redeveloping pretty much the whole thing. Maybe even changing the use. Maybe it was a bunch of single-family homes, you bulldoze them, you title it, and you build office, apartments, and retail. But maybe you keep some of the physical features. So you're redeveloping an existing area, maybe retaining some of it and then improving some of the existing buildings on it and maybe expanding the uses. So redevelopment, there's existing structures already on it that you are developing, redeveloping to bring it to the highest and best use. And then development is you're going out and finding the land, you're getting an architect and an urban planner, you're getting the approvals to put in the plan, the buildings, you're getting the permits, you're putting in the infrastructure, sewage, electrical, all that stuff, and you're building the building from ground up, new construction, approved by the city. So that's development. So as you know, as you go this way, higher risk, higher return. 8 to 10% rate of return, 30 to 40% rate of return. Higher risk, higher return. Any questions on that? That was just a high level view. Any questions? Okay. Industry segments. The capital markets in real estate are segmented. You have public equity, which are real estate investment trusts, which are publicly traded securities in the capital markets, and those companies issue debt and equity to basically fund their development and acquisitions of the properties. They issue shares, they have shareholders, they're publicly traded just like Google, Yahoo, Facebook, any of those other companies, but they own real estate. That's the difference. Their security prices are highly correlated to the overall stock market because they trade on the New York Stock Exchange. And a lot of them are in the S&P 500, or actually they've been pulled out and they have their own segment now, their own industry class. Private equity real estate, huge opportunity here. These are individuals that basically own, run, and manage real estate companies, fairly large, private companies, maybe have private equity or private debt, but they're not public, the securities are not publicly traded, and the company is privately held. Usually they will do these types of strategies, but they will raise capital from individuals, from funds, pension funds, and other sources of capital. And they'll use bank financing too. You have the public debt market, commercial mortgage-backed securities, residential mortgage-backed securities. Commercial mortgage-backed securities are basically loans, commercial loans that are packaged together, underwritten, and mortgage asset-backed bonds are issued based on the loans within the pool. And these pools are rated by the rating agencies, AAA, AA, triple B, double BB, and junk, just like the corporate bonds. You have, and they do that for both commercial loans and residential loans. And one of the biggest market makers in residential mortgage-backed securities is Fannie Mae and Freddie Mac. Okay? And Wall Street is highly involved in this. Private debt is what is called mezzanine financing. Put in equity, I get a mortgage, I get a gap in the financing, I will put a sliver in the financing stack to fill the gap. It's debt, and it gets a very high interest over a short period of time, and then at some point in time, opportunistic guys like to use this, the value add, they like to use mezz financing. Once they've added the value to the property, they get it reappraised, they take the money, they take out the mezz. They take out the sliver. There's funds around this, and there's a lot of capital in here, but it goes in and out. This financing mechanism goes in and out over time. What I don't have is mortgage finance. So if you buy a piece of real estate, since real estate is so capital intensive, it costs a lot of money. Most people don't have enough money to buy the real estate cash outright. They use bank financing. And usually the loan to the value, the loan to value, is usually around 50%. So you have to put up half the price of the building to get the mortgage because the lender doesn't want to give you 70% of the value as a mortgage. They want you to put up more skin in the game because of the financial crisis. So now banks are having you put up more money. Macroeconomic foundations to real estate. The number one equation in real estate is net operating income divided what is called the cap rate is going to give you the value. Net operating income is your rents, minus your vacancy, your gross effective rental income, I'll go through this again. Take out the expenses and you get net operating income. So if this goes up, this goes up. If this goes down, that goes down. If this goes up, that goes down. That goes down, that goes up. So you just play with the equation until you memorize it, okay? So factors, macro factors that are gonna affect the values of real estate is fiscal policy and taxation. If the Trump administration with the two houses of Congress vote to increase the mortgage interest deduction, allows you to deduct more of the interest, the mortgage, would that have an impact on home prices? Yeah, absolutely. But what if the income taxes go up? What if your personal income taxes go up? Would you have more money to buy a house? You'll have less. So taxes go up, the values go down. Taxes go down, the values go up. So when you're looking at policy, particularly tax policy, it has a direct effect on real estate. Real estate. Can I depreciate the building? Yeah, it's a depreciation. Is that a benefit to owning real estate? Yeah. If they start to mess with these straight line depreciation features, you pull back on the ability, the amount of depreciation that you can depreciate in your building, is that gonna have an impact on the value of real estate? Yeah. The 1031 exchange, and we'll go over this. Real estate allows you, the tax laws allow you to exchange your property into the future, and if you buy a like-kind income-producing property at equal or higher value, you can defer the recapture tax, the depreciation, and you can defer the capital gains. Is that important? If they decide to repeal or scale back the 1031 exchange tax features, will it have an impact on the value of real estate? Absolutely. Corporate income taxes, corporations do own real estate, and now they have to capitalize the leases, which means their debt levels are going up. Well, if you're a corporation and you own real estate, and you used to be able to expense your leases, and now you have to capitalize them, is that gonna have an impact?
Yes.
Absolutely. And if you have to capitalize it, it adds debt to your liability side of your balance sheet. What happens to the debt to equity ratio when the debt goes up?
Goes up.
Goes up. And when the firms become over leveraged or have higher leverage, the risk of bankruptcy goes up. And if there's covenants in the bond covenants that basically state that the debt to equity or debt to total market cap ratios should be at a certain level and now they're higher, what has to happen? What happens? Either you sell off assets to pay the debt, or you have to issue more equity. Now, are the shareholders gonna be happy about that? No. What about individual corporate income taxes? How much can I shield? I'm single, I bought a house, I wanna sell it 5 years later. I can basically take off $250,000 right off the top in my gain and not have to pay taxes on the first $250,000. If I'm single. If I'm married, it's $500,000. What if the government decides to eliminate or scale those deductions back? Will it have any impact on the price of real estate? If all of a sudden I can't deduct the first 250 or 500,000 off my capital gains, does that make real estate more or less appealing as an investment? Less. Could it have an impact on the prices? Yeah, absolutely. Corporate structures. People own real estate in different types of structures. Most do not own real estate in a C corp. But most people run their business, their asset management company, as a C corp because of all the benefits. Most people own their real estate in limited liability corporations, LLCs, because it protects them, it's a veil. So if somebody gets shot at their building, that the family doesn't sue the owner because they didn't replace the lighting in the building, which basically created the situation for the person to get shot in the first place. So they have an LLC that wraps the company and creates a veil. It's a pass-through entity, the money comes in, money goes out, you pay the taxes when you get the money. You can use S corps, C corps, LLCs, LLPs, different types of structures depending on really what your motivation is. Does monetary policy and interest rates have an impact on real estate?
Yes.
Yeah. Because in the cap rate, you start with the risk-free rate, which we all know is the real rate, plus inflation expectations, plus some type of risk premiums, either by quality or location or the physical improvement of the building itself. You start tacking on these risk premiums to get the cap rate. Well, if inflation expectations go up, what happens to nominal interest rates? If inflation expectations go up, what happens to nominal interest rates? They go up. If interest rates go up, what happens to the cap rate?
It goes up,
And what happens to values?
go down.
So monetary policy has a direct impact on the value of real estate. The key to this equation is interest rates are going up right now. Right? So you would think that the values of real estate would be going down, but they're not. So what's happening? This is going up. This is still going, the value's still going up. What's happening?
Then the operating income is rising faster.
This is going up faster. It's going up faster. And at some point in time, as interest rates get really high, aggregate demand is going to start to slow. You know, reverse. Okay. Fed policy, open market operations. Does the Fed control short-term interest rates through open market operations? Yes. When the Fed printed $5 trillion through quantitative easing to drive nominal interest rates to zero and real interest rates negative, did it have an impact on the value of real estate? Absolutely. Absolutely. The Fed currently has $4.5 trillion of bonds sitting on its balance sheet. If they start selling off those bonds, what's going to happen to bond prices? They're going to go down, and what happens to interest rates? They're going to go up. If interest rates go up faster than net operating income, what happens to the value of real estate? It goes down. What about if foreign investors, Saudis, Japanese, Chinese, start liquidating U.S. Treasury securities? What's going to happen to the supply of bonds? What's going to happen to the supply of bonds? You're going to go, well, what happens to the supply of bonds when you have foreigners liquidating Treasury securities? Supply's going to go up, and bond prices are going to go down, and interest rates are going to go up. And if interest rates go up faster than the increase in net operating income, what happens to the value of real estate? It goes down. The government currently has $20 trillion of debt outstanding, running budget deficits between $250 and $500 billion per year. What if there's not enough people to buy those bonds to fund the budget deficit? What happens to the supply of bonds? Supply of bonds goes up. What happens to bond prices? Goes down. What happens to interest rates? Goes up. And if interest rates go up faster than the net operating income, what happens to the value? Okay. All right. How much time do we have? Okay. all debt and equity securities in real estate are priced off the yield curve. Yield curve is the maturity on the bond and the interest rate. All debt and equity securities are priced off the yield curve. Yield curves shift up, interest rates go up, and value of real estate goes down. Yield curve shifts down, interest rates go down, values go up. But here's the key. The curve is upward sloping, which means that inflation expectations are positive. We're usually not in a recession when the yield curve is upward sloping. But we're starting to see liquidation of US Treasury securities. We've seen a shift up in the curve and a flattening in the curve on the short end of the term structure. If you go back in time and you look at the curve and how it flattens and then inverts, once the yield curve inverts, the stock market peaks 1 year later, and you are in a recession in 24 months. I'll show that next week. So the yield curve is a predictor of recession. Expected returns for real estate are directly related to the discount rate. So the discount rate, if you look at the discount rate, if you want to use the risk-free rate, which is the base rate, real rate plus inflation expectations. When you're pricing debt, it's going to be real rate plus inflation expectations, which is your risk-free rate. And I'm going to ask you throughout the semester, what's the risk-free rate plus risk premiums, credit default, maturity, liquidity. You have the cost of the debt, risk-free rate. What's the capital asset pricing model if I'm trying to price expected returns on equity? What's the CAPM? Risk-free. This goes up, this goes up, this goes up. The market becomes more risky, cost of the equity, expected returns go up, discount rates go up, values go down. So capital markets have a direct flow into expected returns on real estate, cost of capital in real estate, and as interest rates go up and the market becomes more risky, the discount rates are going to go up, the cap rates are going to go up, and values are going to go down. If you have the cost of the equity and you got the cost of the debt, you can calculate the weighted average cost of capital for a company, use that as the discount rate, do the discounted cash flow model, calculate the present value, net present value, internal rate of return, and the break-even. Test question. If I'm looking at a piece of real estate and I get a negative net present value, do I accept or reject the project? Reject it. Okay. But what if I really want it? What can I do? What can I do? I'm getting a negative net present value on the investment analysis. I really want the property. What can I do?
Offer a lower price.
I can offer a lower price in the amount of the negative net present value, which then would turn my net present value to zero. If my net present value is zero, do I accept or reject? You accept it. Okay, you accept it. So it's really important that you understand that if the WACC is equal to the IRR is equal to the WACC, you're going to accept it. The IRR is greater, you're going to accept it. The NPV is positive, you're going to accept it. If it's negative, you're going to reject it. If you want it, You ask for a price reduction in the amount of the NPV to turn the NPV equal to 0, and you're gonna accept it. And I'll walk you through a lot of these. Okay. Modern portfolio theory, we'll go through this too. Thing about real estate, standard deviation, expected return on the portfolio. This is on the exam. Returns on real estate have low, no, and negative correlation to stocks and bonds. Total returns on real estate have low, no, and negative correlation to stocks and bond returns. So if I add real estate to my stock bond portfolio, what it does is it actually burns out the efficient fund channel. It's gonna lower the return, and it's gonna lower the risk. That's the number one argument for adding real estate to your stock bond portfolio. Because of low, no, and negative correlation. So I'll go through that too. I'm gonna talk about, burn it out here. I'm gonna talk about supply constrained markets and commodity markets. This is in the presentation that I sent you. Okay. Commodity markets get overbuilt. Supply constrained markets don't get overbuilt. Rents and returns are higher in supply constrained markets than commodity markets, because supply constrained markets are either already built out or it's really hard to supply, such as downtown San Francisco is perfect compared to Phoenix, which is easy to overbuild because they have a lot of land. Real estate goes in cycles, highly correlated to the business cycle, but each market, location, different property sector by location, goes through different cycles. And then the valuations, we talked about the perpetuity model. The cap rate model is basically perpetuity, right? We're assuming NOI is gonna be constant forever. Divided by the cap rate, it's gonna be the value. You could subtract out constant growth rate for the NOI into the future. Use the Gordon growth model. You could take the NOI, +1 next year, multiply it by some NOI, no, sorry, the price of the property, by some cap rate, price by NOI, it's going to give you some multiple, it's going to give you the value, and then if you have net operating income for 5 years or 10 years, you can forecast the sales price at the end of the period, discount it back to the present based on some expected return to get the present value, which is the discounted cash flow. What we'll do is we'll do some development examples, and then I'll show you the investment decision making. I think you can turn that off.